Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day, and before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. And today's guest is head of research for Gold, Money, and Shift Gold, and an educator on sound money and demystifying finance and economics. We're going to be talking about the difference between money and credit and the fall of the fiat empire. Is it at hand? Alasdair Macleod, welcome to the show.
Thank you for asking me. Can I just say one thing that we have sold Schiff Gold back to Peter Schiff and his colleagues. So I'm no longer associated with Schiff Gold. I wish them well. I mean, they do a different business really from Gold Money. They're in the sort of coins and small bar delivery business, whereas we're in the vault storage, dealing in vault storage business, as it were.
Right. Well, I had Peter Schiff on the show recently, so interesting to know. And I do want to kick things off with a tweet you made recently that I found very interesting. You said, "I will redouble my efforts to promote understanding of the distinction between money and credit, gold and fiat. Anyone who fails to understand the difference fails to protect their wealth." So here we are. Could you break that down for us and explain to the viewers why gold is in fact money and the difference between fiat and precious metals?
Well, I'll come to that in a second. The basic problem is that very, very few people understand money, if you like. And this was something which Keynes said in one of his earlier books back in 21, I think. I can't quite remember which one it was, but I think he was quoting Stalin, who said something similar. The fact of the matter is that everything we do is actually credit, one way or the other. We never use money. I mean, money basically is a medium of exchange with no counterparty risk. Gone are the days when we even use silver coins or copper coins, which are money. Gone are the days when we used gold sovereigns, which are money. Everything else is credit. And this was something that John Pierpont Morgan, the founder of of various banking dynasties, pointed out to Congress in 1912. Gold is money and the rest is credit. And he's absolutely right. So that's the starting point. And what we've got to do is to break down the barriers from over 50 years of US Treasury propaganda that the dollar is now money, having replaced gold, and gold is now no more than petrol, whatever. So that is my basic task. Now, the reason I think it is very important to do it is that there is this misconception that the gold price is rising, when in fact it is the purchasing power, the values, if you like, of currencies which are declining. And that is the single most important point for people to understand in the relationship between gold and currencies, the relationship between gold and credit. Fiat credit has no anchor in value whatsoever. And, while under normal circumstances, you can say that the quantity of fiat money in circulation, fiat credit in circulation, will determine its value. In other words, if you expand the amount of dollars in circulation, then its purchasing power goes down. Yeah, that's true. But there's another far more important overriding point. And that is that the value of any fiat currency depends on the faith in it. If you lose faith in a fiat currency, then it becomes valueless. I mean, it's as simple as that. And that's why it is so important in these times of huge change, to do everything possible to help people understand actually what's going on. It's not gold price rising. It's the purchasing power of fiat dollars, fiat euros, fiat yen declining. And that's the important point. So in order to achieve this, what I've done is I've set up a Substack channel called Macleod Finance, which is the same as my Twitter handle at Macleod Finance. I'm setting up a video channel as well. That'll come along in the coming weeks. And also I've got a website, macleodfinance.com. So what I want to do is I want to lever up social media to spread this message. Now, I would add at this stage that my commitment to gold money remains as firm as ever. I'm head of research at Gold Money, and I will continue to write for them, as well as for my new Substack. So that basically is my plan for 2024. And I think at a time of enormous change, which we face on the geopolitical scene, on the economic scene, and also with governments, and particularly the US government, entering into a debt trap from which it seems there is no escape. Certainly no escape without massive cuts in public spending, which in an election year, good luck to that idea. So, one way and another, I think that 2024 is the year when we're really going to discover the value of these fiat currencies.
Well, talk to us about that debt trap that the US government, and in fact, many governments around the world find themselves in, the ECB as well. Obviously, these central banks are between a rock and a hard place based on their own misguided policies and their understanding of the economy. I'm wondering where you think this all ends. And also, those who are maybe more conspiratorial minded think that this could be being done on purpose, that these bankers aren't incompetent, they are actually malignant, and it's a conspiracy, if you want to call it that, to crush the middle class and consolidate power. What are your thoughts on that, and where this whole debt situation leads us?
Well, I think the first thing I must do is dismiss any idea of a conspiracy theory. The reality of the situation is that the situation is getting beyond anyone's control. And, the officials in any central bank are having, they must be having sleepless nights as to how to deal with this upcoming situation. Just imagine that you are Jay Powell in the Fed. What do you see? Forget the statistics and forget the propaganda that you put out and all the rest of it. But the truth of the matter is that you're seeing debt getting out of control, government debt getting out of control. You can see the economy tanking. They have, the Fed, through its regional offices, has a pretty good grasp of what's going on the ground around the country, though it doesn't necessarily tell you what it knows. This is the information which it needs to inform itself. It can see that the whole thing is going down. It knows the situation with the banks, which is why it had to rush in and rescue the regional banks from the losses on their bond positions. What bank actually in the old days would buy bonds with a maturity of more than 1 year? This is just complete lunacy. But you had, with zero interest rates, everybody was misled, including the Fed itself, incidentally. Because, one point I would agree with you on is their grasp of economics and grasp of the difference between money and credit is perhaps sadly lacking. Their grasp of the role of interest rates is definitely lacking. These guys are in real difficulty. As to the debt trap, well, you're holding this interview from Japan, while I'm in Britain. The Japanese government has got something like, 260% debt to GDP, and the central bank is underwater big time with its positions in not just short-term government debt, but also long-term government debt, 10-year JGBs and even 30-year JGBs. I calculated at one stage, when I think when the 10-year yield was up about sort of 0.7, 0.75%, that the negative equity on the Bank of Japan's balance sheet was something like 4,000 times its capital. This is so the whole system is actually in enormous difficulties. And if you look at the Japanese commercial banks, many years of trying to create profits out of a situation of negative interest rates means that they have increased their leverage in order to generate a reasonable bottom line. So that leaves them over, with a debt to equity ratio of over 20 times. This has never been seen before. It is that serious. So, the debt trap, basically, it's one thing, if you've got, say, 260% debt to GDP, and you keep interest rates at zero, which incidentally is why they're at zero. But anyway, we'll just gloss over that point. That's not a problem. But as soon as they start rising, Houston, you got a problem. And we're seeing this not just in Japan, not just in the Eurozone, but also in the United States. The United States is a peculiar situation because the proportion of government spending out of the total economy isn't nearly as great as it is in other major economies. But nevertheless, they've got themselves into a debt situation. We've got the gross government debt crossed the 34 trillion line, literally, I think on the 30th of December, 31st of December, whatever. We've just gone over it. In this current fiscal year, I estimate that the combination of interest costs plus the budget deficit in terms of actual spending compared with revenue, the total is going to be over $3 trillion. Now, that's going to push the debt to GDP by the end of September up to, something in the region of 37 trillion, maybe even more than that. So by the end of the year, and given also that this is an election year, and the fascinating thing is they put off the debt ceiling to the 1st of January 2025. Well, what does that do? Any incumbent president, will start spending, try to buy votes, basically. That's what will happen. I wouldn't be surprised to see US Treasury debt approaching the 40 trillion level at the end of this calendar year. Because, if you put a debt stop back, put in a debt stop at, in the early months of 2025, then as a spending politician, you want to get that level as high as possible. So you're going to spend as much as you can before, it's clamped down. So, and the problem really with all this is that the dollar is so over-owned by foreigners. Under the US Treasury tick figures, there's something like 32 to 33 trillion of foreign ownership of financial assets. And on top of that, you've got the derivative position in the foreign exchange markets, which, whereby short-term debt actually should be regarded as bank finance. Bank finance, in this case, we're talking about, if you like, dollar credit, which is created outside the US financial system. And that dollar credit, according to the Bank of International Settlements, over a year ago was $85 trillion. You've got that as well. And then, of course, you've got the Eurodollar markets, which are bonds which are financed, if you like, outside America and held outside America. That's another 10 trillion, according to the Bank of International Settlements. So we're looking at the thick end of $130 trillion overhanging the foreign exchange markets. Now, that is 4.5 times US GDP. So what can go wrong? Well, unless interest rates reward the foreigners for their expectations of the risk, credit risk, if you like, of the dollar, plus what they think the dollar might have in terms of its purchasing power, say in a year's time, if you're, buying a 1-year T-bill, that's what interest rates have got to compensate the foreigners for. And if you don't compensate the foreigners, they're going to sell the dollar. And we've already seen, Powell's pivot, as they're calling it, which was the last FOMC meeting, his statement there, it became quite clear to the markets that the priorities in the Fed had changed from controlling inflation, using interest rates to control inflation, to fears of the debt problem. They need to get interest rates down in order that the government's debt position in 2024 can be financed. And we're talking about $3 trillion of new debt. And on top of that, there's about I think it's around about $7.6 trillion of maturing debt that needs to be rolled over. What is going to be the level of interest from foreigners to support that? I don't think it's really there. At the moment, they've got a sweet spot because money market funds, which have been under Basel III, which is slightly complex, but under Basel III, it doesn't actually suit the large banks to have large deposits. It's an inefficient means of funding the asset side of their balance sheet. So this is why the Fed opened up a channel for the money market funds to go into reverse repos. And they drove reverse repos up in December 22 to a high of about $2.5 trillion. That fell this year, and at one stage it was down to around about 700 billion. And so where did it all go? Well, the answer is it went into T-bills. T-bills, which are paying 5.3, 5.4%. And I think that, therefore, there is this sweet spot. Plus, of course, commercial banks, they realize the risks, the mounting risks in the economy. So they are no longer lending to businesses. They are moving their balance sheet into a government debt, which, according to everybody, is the risk-free alternative, if you like. But of course, if you understand credit, it is certainly not risk-free. But anyway, it is believed to be risk-free. That is the way the system accounts for it. So you move, you stop lending to, Joe's shack out in the Midwest somewhere, and you lend it to the government in T-bills. This is a sweet spot which will stop, and I think it'll stop in the coming months. So then we are likely to have a funding crisis. This is what I mean by a debt trap. The amount of debt and the cost of that debt that needs to be rolled over is becoming the dominant problem in America. Not many people seem to realize it yet, but that is definitely the case. They think that interest rates are going to go lower. That is wrong. They may ease slightly temporarily, but the effects, the consequences of having to fund this debt are highly inflationary in the sense that it will undermine the purchasing power of the dollar. If debt is used constructively, if credit is used constructively, credit, debt, they're the same thing effectively, then it's not inflationary. But when a government steps into the arena and starts funding its deficit, this is not the application of debt for constructive or productive means. It is destructive of the purchasing power of the currency in spades. And I've looked at the statistics going way back, and in this country back in the 19th century. We saw between 1844 and 1910 or thereabouts, that there was very little expansion in the coins in circulation. I'm talking about coins and notes actually in circulation, coins being sovereigns. Where the expansion was multiple times in commercial bank credit. And the reason it wasn't inflationary is quite simple. The expansion of commercial bank credit, while it is cyclical, due to psychological factors, is actually credit deployed for productive purposes. And the result was there was no increase in prices over the whole of the 19th century. That is where we need to get. But coming back to this debt trap problem, if they try and resolve it by expanding the amount of central bank credit, expanding, let's say, base money at the Fed, then it's just going to simply undermine the purchasing power of the dollar, which basically means that the Fed has lost control of interest rates. The market will set them. The market will determine that they should be higher. Why? Because the foreigners will be selling down the dollar. So it's a long explanation, but I think it is important to understand the dynamics there.
Absolutely, and a very thorough explanation. So, very much appreciate that. You recently made a post on your Substack called An Insight into Russia's View on Gold, where you included the English translation of a Russian article on the importance of gold for the Russian economy. Could you break that down for us and explain how Russia views gold and fiat? And is the Russian economy in a different position than that which you've just described in America?
It's very, very different. I mean, the Russian economy sort of more or less it goes along, I suppose, with what the Austrian school of economists would call the desirable situation. Income tax is 13% up to, I think, 5 million rubles, and then the highest rate of income tax is 15%. Oh, this is dreamland. It really is. Now, there are other taxes, admittedly, but you can see that there is not the disincentive that we have in the West towards running out and actually producing something, because the state takes most of your money. So that's the first thing. The second thing is that Russia's debt to GDP, despite all the war spending in Ukraine, is only 22%. Yeah. And she's got a surplus on a balance of trade. Okay, certainly due to her export of commodities, particularly oil and gas. It is underlying a very, very strong economy. The thing that's wrong with it is the international credibility for the ruble. Now, I mean, an interesting thing is that while the underlying economic situation is so strong, the ruble basically has been incredibly weak. I mean, it's backed off from its lows, but it was 1 ruble 1 cent at one point, US cent, which I think goes to reinforce the point I was making, that when you've got a fiat currency, it is the credibility in the markets which will determine its purchasing power. That's what the Russians are finding. Now, there is within Russia, sort of various schools of economic thought, I suppose, but one of the most important economists is a guy called Sergei Glaziev. Now, he was appointed by Putin to oversee the means by which the Eurasian Economic Union would manage to do without the dollar. The Eurasian Economic Union is basically a collection of countries which are to the south of Russia and to the north of, I suppose, Tibet and Afghanistan and so on, plus Belarus, and of course, including Russia herself. These countries don't really rely very much on imports from the Western world. Yet, in their transactions, they have to use dollars. And the reason they have to use dollars is if you, let's say, you're an importer in country A, you've got your own currency, but as an importer, you've got to pay, the person that you're buying goods from abroad from. So what you have to do is you have to sell your currency, buy dollars. And if he won't take dollars, which is usually the case, then you have to sell dollars to buy his own currency to credit his bank account. So the dollar is always in there. It's the piggy in the middle, as it were, in these transactions. I mean, obviously, when it's state to state, this isn't the case. So, the arrangements that Russia has directly with China at a state level, that doesn't involve the dollar at all. But for ordinary trade, you have this extra step. And this means two things. It's expensive, unnecessarily. And the second thing, which is more important, is that every transaction in dollar credit If it is done through an American bank, which is usually the case in the foreign exchange markets, or very often the case, then that deal is reflected back in New York in that bank's accounts, so that the American intelligence services, if you like to put it that way, do have a pretty good handle on everything that you're doing, back on the Silk Road. So that was the whole thing. Now, Sergei Glaziev has moved, I think, very much from the original concept, and that was, there would be a basket of commodities which are common to the Eurasian countries, and also it incorporate their currencies. Now, that was just unworkable. I mean, you could have told that right from the start, but I think that was the hook, basically, to get him in, to get him politically accepted by the participants as someone who could do this. And he's quite clearly moved towards gold. Why? Because gold is, if you like, the de facto representative of commodities. And if you look at the values of commodities expressed in gold over long periods of time, I mean, some go up, some go down, but basically there's not all that much change. And in the case of oil, I mean, it's we've seen in dollars that the price of oil since the 1950s has gone from $2.50 a barrel up to a high in 2007-8 of around about $140 a barrel. And at one stage, it even went negative, if you remember. I think that was April 2020, due to technical factors in the market. So, pricing oil in paper currencies is very, very, very volatile. Yet, if you look at the price in gold, the worst of it, I think, was up 2.5 times, and the least of it was down about 50%. Now, that's considerably less volatile than anything that a fiat currency can do. And for the record, at the moment, I think we're about 20% adrift from 25% adrift, I think, from that 1950 price. So this is something which has not gone unnoticed in the largest exporter of energy in the world, i.e. Russia. Now, Glaziev, I would say that if he was in the West, he would be, very much an advocate of Austrian economics, sound money. Anyway, he wrote this paper for Vodomosti, which is a Russian business paper based in Moscow. And in that, he advocated that Russia should go on to a gold standard. He gave us a bit of a history, because Stalin, he signed off on the Bretton Woods Agreement. He ratified that agreement, but he went on to his own gold standard, not through the dollar. And that gold standard basically was abandoned by Khrushchev. Now, when the gold standard was abandoned, was it of any value to Russia? Did it achieve anything? I mean, Keynesian would say that the rapid depreciation of the ruble would have stimulated the economy. No, I mean, the economy just slid down into an ever deepening mess, so that, we know what happened under Gorbachev. This is all understood by Glaziev, and he was making the points in his article, and he was effectively saying that we need the Golden Ruble Mark III. That was actually the title of his paper for Vodomosti. And as you say, I think it's very important to understand which way this debate is going in Russia. I wouldn't say that everybody in Russia is, in the economic sphere agrees with Glaziev, but I think President Putin is certainly sympathetic to it. And bearing in mind that Putin sees the dollar as the currency of Russia's principal enemy, then I think that makes him even more keen, if you like, to have a sustainable currency. Because apart from anything else, look at it from Russia's point of view. At the moment, the central bank has interest rates of 16% in order to try and stabilize. I mean, really stabilized the ruble. I mean, the money supply, broad money, has been increasing at something like 20% which is far too high. But I mean, the real reason you need interest rates up is to protect the ruble, protect the fiat ruble. So if you did away with the fiat ruble, what would the interest rate level be? Well, it would gravitate down towards 2 or 3%. And so long as the central bank, the Russian central bank, doesn't actually rush out and expand its balance sheet by printing currency, if it becomes basically not a central bank, but an issuer of rubles in return for gold, it would rapidly get its gold reserves. And not only that, but the inflation implications throughout Russia, inflation would die. I mean, it just wouldn't happen. And think of how that would stimulate entrepreneurial production. And on top of that, as I said earlier, the maximum income tax is 15%. I mean, actually, we should all be moving to Russia if it was. This is assuming you can turn a blind eye to the politics. I mean, there are other problems, and I mustn't gloss over those. But, we're just looking at the economic effects. And I think the point which has to be understood is that Russia is probably got the best economy to introduce a gold standard. It won't have to cut government spending. It won't have to, raise taxes in order to close the deficit or anything like that. But what it does need to do is it needs to evolve from a pure dependency on exporting energy, oil and gas, which can be sanctioned, whatever, into, if you like, organic progress within the Russian economy itself. And that way, the Russian people will become wealthy. Now, Putin, and I hear this from various sources, that Putin sees himself, if you like, as a latter-day Peter the Great. In other words, he wants to go down in history as the man who was most important, or one of the most important men in Russian history. Now, if he's going to achieve that, it's not just a question of booting America out of the Eurasian continent. It's also going to be the condition, if you like, of the domestic economy and the wealth which is created for the Russian people. So that's why, and this is the basic point behind Glaziev's article. And as you say, I mean, I got the translation, I put the translation onto my Substack. You'll need a subscription, but it's a free subscription to read it. So, go and have a look at it. It's, I think it's absolutely fascinating in the context of the current monetary and credit debate.
And do you think we could see other countries potentially make a similar move towards considering a gold standard? Obviously, we've seen central banks accumulating gold at a very rapid pace, both in 22 and 23. A lot of people point to the fact that it was the US seizing Russian FX reserves that led a lot of these countries to realize, okay, maybe we need a store of wealth that is outside of the power of confiscation of the powers that be, because this time it's Russia. Who knows who they want to sanction next, who the next political opponent is going to be. Do you think part of the impetus was potentially to move more towards gold in the monetary system as potentially a way to counteract the dominance of the US dollar? Do you see any other countries potentially heading in that direction? And as a follow-up as well, how would such a gold standard be implemented? Do you think we could actually see coins returning into circulation, or would it be a blockchain technology? How would that actually work in practice, in your view?
The two big issues that you're raising there. I think the first is why are central banks accumulating gold? I mean, the answer basically is, as you rightly point out, they have woken up to the fact that there are problems with the dollar. And one of those problems is that they can confiscate your reserves if they decide they want to. What this does actually is it rather than making countries thinking they should consider a gold standard, I think for most of them it's a question of protecting themselves against the changing conditions which are obviously happening. I mean, we're moving away from the sort of the post-Bretton Woods era into what Zoltan Pozsar called Bretton Woods 3. In other words, there's a new era coming, which at the very least is going to look like the 1970s, with instability in terms of purchasing power for fiat currencies. And I would agree with that. And I would say that there is an increasing likelihood that this leads to the collapse of the fiat currency regime entirely. But let's not go there for the moment. As to your question as to whether other countries are considering a gold standard, I have no doubt that China is considering this as well. But China does not. It takes a sort of evolutionary approach to matters. She doesn't sort of rush out and suddenly do things, as it were. Her strategy basically is to let others make mistakes. And America has been making all the mistakes, and China just sort of sits there. Nothing to do with us. We're just running our own affairs. And that's the sort of Confucius approach, if you like, Confucian approach, which actually is very much in the government psyche. I reckon that since 1983, when they first started accumulating gold, because they appointed the People's Bank specifically to do that, and I've got the original articles, which I'll put on my Substack, actually, it's a good idea. The original legislation appointing them. Now, what they did basically was they controlled the foreign exchange flows because no one in China could buy foreign currency. So everything had to go through the People's Bank. They siphoned off some of that. You had capital inflows in the 80s and in the early 90s, and then you had increasing exports. So you had a balance of payments bringing in foreign currencies. So between 1983 and 2002, I reckon, looking at those flows and all the rest of it, and contemporary prices, and remember we had a massive bear market in gold, which took it down to under $300 in 2002. I reckon that China could have accumulated by then something like 25,000 tons of gold. Now, there are various other indicators that she had been doing this, such as her policy towards gold. None was allowed to leave the country, and it's still the case, incidentally. And furthermore, she invested very heavily in mining capacity and refining capacity, so much so that China rapidly became the largest nation by mine output, gold mine output, and has held that position ever since. Now, in 2002, for the first time, she permitted her own citizens to buy gold. And this was why the Shanghai Gold Exchange was established. And that is under the control, guess what, of the People's Bank. There have been times when they have deemed it sensible to even advertise, go and buy gold. It does you good, or whatever the byline was. The result is that not only has the state continued to accumulate gold, and I would think at the moment she's got well over 30,000 tons. I mean, it could be 35,000 tons for all I know. But also, her people have taken delivery of around about 23,000 tons out of the Shanghai Gold Exchange. This is another point, incidentally, that Glaziev made in his Vedomosty article. Now, this tells me that they do understand that gold is money and the rest is credit. They understand this at the highest levels. I mean, don't ask President Xi, ask his advisors, if you like. The point behind that is that they understand they need to protect their currency against the event which they were always taught in the Marxist schools, Marxist universities, the economics courses, always said that, the capitalist system would eventually collapse and take their currencies with it. Yeah, well, here we see, for those guys who are old enough to remember those courses, they're seeing this actually happening now. So we're going to get a situation, I think, where instead of trying to protect her export trade by ensuring that the yuan is, sort of some sort of comparative level to the dollar in the foreign exchanges, she's going to, at some stage, turn around and have to protect the yuan from a collapsing dollar. So that's the first thing. Other countries which could go that way, I think Saudi Arabia will. I think Saudi Arabia would probably begin to go that way by taking more and more payments in gold. I mean, not totally in gold. I mean, she'll run some sort of balance. Um, I mean, this is this fits in with the end, if you like, of the exclusivity which the Saudis gave and OPEC gave to the dollar as the exchange medium for oil and gas. So that's now happened, which is interesting. And as a side point, I was talking to a director of one of the Swiss gold refineries back in 2014. So this was some time ago, 9 years ago now. And he told me that they were taking in 400-ounce LBMA bars from Middle Eastern sources with instructions to re-refine them into the new Chinese 49 standard and then ship them back to the owners. Now, that's interesting because it tells me that this idea that, suddenly the Saudis are booting out the Americans and embracing the Chinese, I think that the strategists, in Saudi Arabia and elsewhere, the businessmen with real wealth to protect understood even that long ago that the future for Saudi's oil exports was very much bound up with the dynamics of China and India, which at that stage were beginning to really sort of take off. So I can see the Saudis doing it. Now, as far as BRICS are concerned, I think that BRICS and the Shanghai Cooperation Organization will move towards replacing the dollar as that sort of stepping stone between currency transactions from currency A to currency B, with credit backed by gold, whose value is entirely tied to gold. Russia has taken on the presidency of BRICS as of January the 1st. She plans, and this is according to Putin's speech on New Year's Day about BRICS, she plans 200 meetings, which is 5 a week over the course of this year, held in Russia, educating BRICS and also potential applicants of BRICS as to where Russia sees this going. And I would bet worthless dollars, if you like, against gold, that the BRICS gold trade settlement currency, which for lack of actually defining it, will be back on the agenda, and this time it will pass. The meeting, the big meeting, the big final meeting is actually in October, whereas it was in August in Johannesburg. So that's going to give them 10 months basically to achieve this, and I think they will, because by then I would fully expect the dollar to be in serious decline because of all the debt trap and and all the other factors we mentioned earlier. Other than that, I think that countries. I mean, it's amazing how countries like even Kenya. The president of Kenya seems to understand the benefits of sound money as opposed to credit. Now, I mean, he's presided, not him, but his predecessors have presided over a collapsing shilling. This is the big lesson. Look, it's confidence in your fiat currency. And, if you're a tin pot country somewhere in the middle of Africa, nobody's going to value your currency. It doesn't matter how you run things. So this was the great thing. This is the great lesson. And this was really the reason that Russia must get onto a gold standard. And I think she will be the first. And she could well do it ahead of that October meeting. So it's going to be a very interesting year.
And just to follow up there, how do you think that will be executed in practice? Will it require some sort of digital currency backed by gold? Do you think we could actually see gold coins themselves, silver perhaps, be transacted? Will it be a gold-backed paper currency? What do you think is the most feasible way for them to actually execute that?
Everybody wants to talk about blockchains and all the rest of it. I mean, it's a load of rubbish, actually. It's very, very simple. This is why it's important to understand how credit works. The answer basically is that any bank. I mean, I actually wrote about this some time ago. Is quite a complex or it would take me some time. It would take me another hour and a half to explain exactly how the whole thing works and why it works. But believe you me, it is not difficult to set up, if you like, a sort of central agency which will hold gold bullion against which it will issue the new currency. Commercial banks, in terms of trade settlement, trade finance, and all the rest of it, will be able to create credit, their credit, denominated in this new currency. And that is where the expansion of it will be. You don't need blockchain. You don't need, all this sort of stuff about digital currencies. I mean, it's a load of hogwash, really. The answer, Jesse, is it's actually extremely simple to do. What you have to do is to ensure that the issuer of the currency has only got one function, and that is to issue the currency and manage the reserves. It must not be involved with banking. Leave that to the commercial banking network. That will create the credit on the back of it for trade settlements. Incidentally, a lot of which is self-extinguishing because, that's the point about trade finance. It's the temporary finance, if you like, of goods from point A to point B. Once that's delivered, the credit sort of, it disappears. So, this is something that is actually very, very easy to implement. The implications of it are that, not only the central issuing entity will need to acquire the reserves, which it can do out of, let's say, the member states that are involved, but also there's going to lead to greater demand for bullion generally, which is an important point. And it's going to lead to, if you like, less demand for dollars. So, that balance is going to be very, very much anti-dollar. And I think this is why the Chinese and the Indians were reluctant to endorse this move in Johannesburg. They didn't want to talk about it. They were the guys who basically said no.
Well, Alasdair, it's been an incredibly enlightening conversation. Thank you so much for joining us today. Before I do let you go, could you tell us about Gold Money and your new Substack, where people can find that as well?
Yeah, sure. Gold Money basically buys and sells metal on behalf of its customers and stores it on a custodial basis. So, and we offer, I think, something like 10 or 11 vaulting options around the world. So our customers can pick where they want to put it. I mean, our American customers very often want it stored outside America because, they know that the president can turn around by executive order and confiscate your gold, but they can only do that within America. Others take the view they'd like to vault it somewhere not too far away from them so that, they feel more comfortable. So, the choice is there. I think that's the important point. The most important point is that it is not our property. It is the property of the individuals, and it is recorded as such, and there's a continuing audit which shows this. So that's basically what Gold Money does. My Substack, as I said earlier, I want to use social media as much as possible to increase awareness of the issues that we've talked about today. And so I set up the Substack channel. In order to receive Substack, and there are very many, very, very interesting writers on Substack now. So you should get the app because it'll enlighten you, I think, to quite a lot of. It give you access to quite a lot of writers who are very, very good, well informed. So Substack is, you can get an app which you put on your phone, and you get the alerts, and it just reads away. You can read it easily. So And 68% apparently of people read articles on their phone nowadays rather than on a computer, which is an interesting statistic. And I really do think that, with the help of a few of my friends, I can probably get that, the subscription level up. There are two levels of subscription. You got free level, which will have, some summaries, some videos, which will link into my YouTube slot, as it were. And but the longer form articles, which at the moment I write for Gold Money, will go to the paid subscription facility on my Substack from the beginning of February. I will still continue to write, obviously, for Gold Money as I remain head of research there. But the long form articles, I think, where I try and explain things, these issues that we've been discussing, will be available to subscribers, and it's not a lot of money. And I think the important point about subscribing, paid subscriptions, is that if you pay for a subscription, you tend to read things, whereas if you don't, it's just another bit of information. So I think it focuses the minds at very, very little cost. So anyway, that's my advert over.
Great. Well, I'll put links to both Gold Money and your Substack in the description below so people can check that out. Thank you once again, Alasdair, for coming on and sharing your knowledge with the audience.
That's very much my pleasure, Jesse. Thank you for having me on.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.